Welcome to today's practical planning tip by ParkBridge Wealth Management. My name is Jonathan Shenkman. I'm the President and Chief Investment Officer of the firm. Today, I'd like to continue our video series on buying a home, and today, I'd like to discuss why a home is a bad investment. First, and something I alluded to in my previous video, is schwach, or Yiddish way of saying bad returns. Oh, let's do that again. I'm going to start all over, okay? Welcome to today's practical planning tip for ParkBridge Wealth Management. My name is Jonathan Shenkman, and I'm the President and Chief Investment Officer of the firm. Today, I'd like to continue our video series on buying a home, and today, I'd like to discuss why a home is a bad investment. First, and something I alluded to in my previous videos, is schwach long-term returns. Historically, housing returns vary by region and even more by specific cities within a region. However, according to the Case-Shiller Home Price Index, a widely recognized measure of U.S. residential real estate prices that tracks changes in home values, home prices have appreciated an average annualized rate of 3 to 5% over the long term. As I already mentioned in previous videos, these percentage returns don't factor in the cost of home ownership. By way of comparison, the U.S. stock market has annualized approximately 10% a year over the past 30 years, while more conservative bonds have annualized around 5%. Next is illiquidity risk. This refers to the potential difficulty of selling an asset when you need the funds without significantly impacting its price. Unlike stocks, many investment grade bonds which can be bought and sold throughout the trading day with ease and minimal costs, real estate can take months to sell and typically at a significant expense. If you purchase a home, you better plan to stay there for a while or you may not recoup your transaction costs. Next is concentration risk. Concentration risk refers to having too much of your assets in a single investment. Unlike stocks and bonds, which can easily be diversified across hundreds of different positions, a house is an asset in one asset class, real estate, and in one market, your community. That is a lot of your eggs in one very specific basket. If your community experiences unfavorable changes, including demographic shifts, oversupply, or more attractive nearby communities, or more broadly, if there are economic downturns or prolonged elevated interest rates, the value of your house can drop or remain stagnant for years, which may derail your financial life. And finally is the use of leverage. Leverage or borrowing money to invest is risky because it amplifies both gains and losses. This means that while it can enhance returns, it can also lead to significant financial distress if things go wrong. For example, interest payments on one mortgage can erode profits if returns don't exceed borrowing costs. Furthermore, too much leverage can have a ripple effect on the rest of your finances, making it more difficult to generate sufficient cash flow to afford your other expenses. Leverage can be a powerful tool, but it requires careful risk management to avoid financial instability. On my next video, I'll share why I still believe owning a home is a sound financial decision. With that, I hope you found this practical planning tip helpful. Until next time, stay prudent, practical, and don't forget to plan ahead.